Welcome back, folks. You're still watching Smart Money on CNBC-TV18. We're speaking with Vishal Kapoor, who's the CEO of Bandhan AMC, and we're talking about all the investing mistakes that you should avoid. Now, before the break, Vishal was telling us how shifting of your goalposts is something that you should definitely avoid. If you have a target, then you should stick to it. Vishal, it brings me to the question, whenever anyone picks a mutual fund, mostly people tend to look at past returns to decide which mutual fund they should take. But I understand that that is the biggest mistake that people make. Correct me if I'm wrong, and also tell me, how does one pick a mutual fund then?
Right. So, let's look at, any market cycle, right? And you have 10 fund houses and 10 fund managers who've tried their best to sort of outperform in that market cycle. And let's look at 3 of them who really got it right, and they ended up at the top. Now, these 3 funds or fund houses got this cycle right, and therefore they ended up in the top. Often the mistake we make is we choose all 3 of them. We think we are diversifying by buying 3, but actually we are buying the exact same style or exact same reason that got us to the top, right? Now, does that give us any comfort that they will beat the market again in the next one? Yes, maybe they're great managers, they may do it, but there's an equal probability someone else who did not perform may actually bounce back up. And that we keep seeing study after study that, yes, there's a level of consistency, but the outliers often change quite rapidly. So one way to do it is to actually diversify, which is one of the reasons you are buying multiple funds. Just don't add new fund schemes to your portfolio and think you've diversified. Diversification means you're adding different styles to your equity allocation. And therefore, if you have to choose 3 funds, choose 3 different styles, 3 different ways of managing money, so that given different cycles in the future, you have a better chance that in aggregate, you will be able to do well rather than just chase the same style 3 times over across the same, 3 funds.
Okay, got it. Also, you talk about poor scorekeeping as the 5th mistake. Tell us a little bit about that. What do you mean by scorekeeping, and what should people do then?
Right. So a common error we find is that people look at, or investors look at, point-to-point returns to decide how their funds have performed. Right. So as an example, I may look at a fund and then find that, oh, actually the fund has returned 5 or 6%, and I'm not happy with that return, right? I miss the fact that the same fund, I may have invested in that fund through an SIP, and my returns are actually closer to 9%, which is okay, right? Now, why does that happen? Because my SIP return is a monthly investment. It is taking care of, the reason, one of the benefits of SIP is rupee cost averaging, and that rupee cost averaging has given me that extra 4% of what I would call process alpha. The alpha is just because you were in that fund, and because you were averaging every month, your return was 9%. Now, the decision point is, had I known it was 9%, I would have been very happy. But because I thought it was 5%, because I was looking at a fact sheet, or I was looking at a table, I was looking at some other analysis which said, oh, 5%, I'm not happy, I make the mistake of switching it. So the point is that if the scoreboard is wrong, you're looking at the wrong scoreboard, you end up making mistakes like this. And therefore, one way out of that is look at rolling returns. So if you're investing regularly through an SIP, a rolling return is a far better metric to see what your returns are. It's not an exact metric, but it's better than looking at point-to-point returns, which has huge biases because of the measurement time period that you may be subject to.
Okay, all right. The 6th mistake is underestimating the power of compounding. And, Albert Einstein said that the compounding is the 8th wonder of the world, right? He said it for a reason. I mean, we all know how it works, but a lot of people are still unfamiliar with it. So you want to take us through that?
Yeah. So again, one of the data that I mentioned earlier, which is that holding periods just seem to be too short for most of us, right? And I think repeatedly we underestimate how quickly compounding really adds value, to our lives. So in a recent, fund, or if you look at an index, often we miss out what this adds up to. So for example, recently I was talking to some investors and I told that, this index returned, let's say 14% over a long period of 18 years in this case. And would you be happy? And they said, yeah, maybe it's okay. And when you tell them, oh, actually, your 1 lakh would have become 11 lakhs, would you be happy? Of course you're delighted.
Yeah.
It's the same result. It's just that you don't realize that 14.5% compounding over 18 years would have meant that your money became 11 times or 10.5 times, right? So the absolute is what we understand. The percentage and the compounding over a long period of time, we just intuitively don't get. And therefore, we don't stay put for long enough. And that, to me, is fundamentally one of the biggest mistakes when we are investing through equities.
Oh, absolutely. And there's that old maxim, right, which says that time spent in the market is more important than timing the market. So I guess that's very important. All right, let's go to the last mistake, failure to diversify within an asset class. What do you mean by that? You were mentioning earlier, right, as to how don't put all your eggs in one basket. But at a time like this, where it's very hard for people perhaps to, look at individual stocks, there's so much volatility, don't you think it's best to just sit put with ETFs or with index funds, large, mid and small cap? Don't you think that will be the best way to approach the market?
You could. But I think as the recent past has shown us, there is some significant alpha that can be generated by active managers. And we are seeing that, and you see that in waves. There's a wave when it's difficult to beat the market because one part of the market did very well. But then there are other waves when you can generate very, very significant alpha. One of our funds, for example, over 3 years compounded is delivered, more than 15% alpha. So, there's a significant amount of outperformance. But coming back to the point, again, it goes back to what we mentioned earlier, which is that often I see investors making the mistake of saying, okay, let me pick the 3 best performing funds, right? And, Google search, best performing funds, drop down, and then saying, okay, top 3. Now, as I think most market participants will understand that the top 3 at any given point in time will have very similar characteristics. Often those are sectoral funds, as an example. So there's a certain market phase where past performance of sectoral funds have done well. So you end up buying these 3 sectoral funds. You think you're diversifying, but you're not. You're actually a very, very concentrated equity portfolio. So the point is that when you're buying, just adding more funds is not leading to diversification. You have to look at within that asset class, how are you diversifying? So is there enough large cap? Is there enough mid and small caps? Are there any sectoral plays? A core satellite approach that we spoke about often works as a very reasonable way to sort of do that, which is have some part of your portfolio which is really buy and hold for a very long period of time. Of course, review it. If some fund manager is consistently not performing, you can make a change. Maybe have some sectoral positions or some alpha generating positions, which are themes that you like, that you're convinced about, which is sitting on top. But more and often than not, we find that people are just buying top performing funds based on a listed and changing it too often. So you're really not giving any theme a reasonable time for it to perform.
Okay, all right. Before we wind down, Vishal, since you've spent so much time in the market and there are a lot of people, as we've been seeing, demat accounts are at record highs, a lot of new young investors entering the market. What would be your biggest advice to a young investor between the age of, say, 20, 25 or 30 trying to build their portfolio?
Okay. I would say, since we were using the sport or the football analogy, I would highly recommend that, find yourself a coach. It doesn't have to be, an advisor MFD, although I would highly recommend that. But, often because it's your savings, your money, you can get very closely involved and we can read up and try and do things. But the behavior, at least in aggregate, seems to at least imply that a lot of misbuying may happen. You buy something with the wrong notion in mind because you're also learning, right? And therefore, having someone slightly, distant in a sense, even if it is an expert, it's even better.
Who looks at it with an unbiased perspective.
Exactly. That can really help. So, like in the best of, the players needing a coach, you need a coach as well.
Okay. Like for everything medical, you need a doctor, right? You can't prescribe your own medicine. I guess you need a financial doctor as well to help you with your, financial health. Thanks a lot, Vishal, for joining us. Really appreciate your thoughts here on Smart Money. Thanks for being with us on the channel.
My pleasure. Thank you for having me.
All right, folks, with that, it is a wrap on this edition. Thanks a lot for watching. Keep writing to us. We love receiving feedback from you. Till then, have a great weekend.
ज्योति, अब ये बैग क्यों उठा लिया?
मम्मी, मैं जस्सू के घर जा रही हूँ पढ़ने, क्योंकि कल पेपर है ना हमारा।
बेटा, ऐसे रोज रोज किसी के घर में